Presentation of financial statements in Companies Act, Schedule number 3, the financial statements are prescribed. Now, initially we have been given some understanding related illustrations like going concern concept as well as liquidated concept, accrual basis and all. Okay, that you may already have small idea about those things that your preliminary studies itself. You know, just give this as a summary at the last. Okay. Now, my focus is to make you understand the preparation of the balance sheet as well as profit and loss account, which is given under Schedule number 3 of Companies Act 2013. And Part 1 prescribes the format for the balance sheet, and Part 2 prescribes the balance sheet for the profit and loss statement. So, while presenting the financial reports, you should present not only balance sheet and profit and loss, cash flow statement should also be forming part of the financial statements to be presented by a company. And changes in equity, how the equity shareholders net worth changes from the previous year to this year due to any change in the retained earnings or fresh issue or buyback of shares and all. You have to give us a statement also, which is called changes in equity. And notes to accounts. Okay, what are the assumptions you have done and what are the changes you have done with respect to the principles from the previous year should also be given as a note form, which is called notes to account. So, Section 129 of Companies Act prescribes this one. So, you have to follow the gap and provisions of the Companies Act, and you have to follow all accounting standards. Okay, so you have to be master of all the accounting standards and apply all those accounting standards, rules, and regulations while preparing the financial statements, right? And this notes to accounts is reported in board's report also as a board report, okay, under section 134. Apart from that, SEBI requires listing company to prepare consolidated financial reports, CFS also, as per AS number 21 and 23. So that consolidated financial report for AS number 21 and 23, okay, one is having full control, another one is the substantial interest you have. So these two will be now consolidated in a single form. So which is to be prepared as per SEBI's requirement. So all these 6 elements will be there for financial reports for a company, a listed company. Is that okay? So balance sheet should be as per the format given in Part 1 of Schedule number 3. P&L account as per the format given in Part 2 of Schedule number 3. Cash flow statement should also be there. Changes in equity also be given. Apart from that, notes to accounts, and SEBI also requires to prepare the consolidated financial statements as per AS number 21 and 23. Now, let's see Part 1 of Schedule number 3 of Companies Act. Okay, this is the full set we have been given. So, usually your balance sheet will have particulars column, notes to accounts column, and current year data along with previous year data, previous year for the first previous year and second previous year, like at least 2 previous years information should also be there along with the current year's financial data, so that there will be a easy comparison between the current year's data with the previous year's data. If there is an exorbitant changes, then you have to give the disclosure. Okay, you have to give the notes to accounts. Is that okay? So here you have to understand 4 predominant heads in your balance sheet. In your balance sheet, 4 predominant heads. One is a shareholders funds. Another one is share application money pending allotment. Share application money pending allotment. Okay. And third being non-current liabilities, and fourth being current liabilities. These are the 4 predominant aspects you have to prepare in the liability side. Is that okay? In case of asset side, 2 predominant items. One is non-current assets. Another one is current assets. So you have to understand the major heads in the liability side as well as in the asset side. In the liability side, we have four heads. Okay, one is shareholders funds, another one is share application money received, but allotment has not been done at, currently. So application money received, it may be refundable if it is being the excess application money, or suppose under subscription happened, we are not able to allot, then we have to cancel and refund this money. So in case of refunding, this becomes a liability. If it is going to be allotted to share, then it will be shareholders' funds. So until that period of allotment confirmation, it will be kept as a separate line item between 1 and 3. Okay, 1 is shareholders' funds and 3 will be the non-current liabilities. In between, we have the share application money, application money pending allotment. Now let me try to finish off each and every aspect slowly. Okay, in shareholders' funds, we have three items. Okay, so one is all about share capital, another one is reserve fund, reserves and surplus. Okay, it's very simple. In the liability side, you will start with the capital, and next you will start with the profits and losses accumulated in the up to the year end. And the third one is money received against warrant. Money received against share warrant. Okay, under shareholders funds, equity and share liabilities under shareholders funds, we have three blocks. One is share capital. What will be there in the share capital? Equity shares, preference shares. Okay, even if there is any calls in arrear, any amount forfeited, all these things will fall under share capital only. So it's not only the equity share capital; it comprises all the shares. And reserves and surplus, it comprises all sort of reserves and surplus: capital reserve, general reserve, profit and losses, and capital redemption reserve, securities premium, whatever it may be, everything will come under reserves and surplus. Is that okay? And C, money received against share warrant. Share warrant is nothing but a coupon, like giving the options to the holder to purchase the shares in the later period at much discounted price. Okay, so I am giving the option warrant to you. Okay, you pay me 10 rupees. In a matter of 3 years later, you can purchase a share from our company. Okay, the share price in the market may be 100, but you are eligible for purchasing it for 60. This will be offered to honoring or giving some benefits to the existing shareholders or some directors. Okay, their exemplary contribution done for the company offers them to purchase the shares. Those things are called share warrant. That payment will be not considered as a share capital. The moment it is allotted as share capital, it will be part of share capital. Until that period, it will be a separate line item under shareholders funds. Okay, money received against share warrants. Hope you will be now able to understand. So what are the things are there? Okay, in case of equity and liability, you have one is shareholders funds, second one is share application money pending allotment, third one being non-current liabilities, fourth one being current liabilities. Very simple. That's how you have to understand the four major blocks, and then later you learn what could be the internal items available. Under shareholders funds, we have three blocks. One is share capital, another one is resource and surplus, third one being share warrant. Share capital comprises equity preference shares as well as forfeited amount as well as calls in arrear, whatever it may be, everything is adjusted in the A block itself. And resource and surplus may be capital reserve, general reserve, profit and loss, whatever it may be, CRR, securities premium, everything will fall under this case. Clear? Now, under shareholders funds, A, share capital, calls in arrear, forfeiture. Show 5 years details. You have to show 5 years details for the shareholders funds. Okay, you need to know what is the share capital 5 years ago and today. How these share capitals are changing over the 5 years period. You have to give the 5 years details. Is there any further issue? Is there any buyback of shares? Is there any calls and arrear forfeited? And all these things will be reported, 5 years details. And source of share capital not required. How do you get the collection is not required. Okay. So the share capital, you say that I issued 1 lakh rupees shares, 1 lakh shares for rupees 10 lakhs. I collected 10 lakhs rupees. Don't show who has paid the 10 lakhs rupees and all. So that source is not required. Its source is not required. Hope you'll be now able to understand the first block. Second block, reserves and surplus, capital reserve, CRR, capital redemption reserve, securities premium, and profit and loss, like all the accumulated reserves will fall under this case. And third one being money received against share warrant. Warrant is nothing but the options to purchase the share. Okay, maybe you might have paid some amount now, but share will be allotted later on only. Usually, it will be having a discounted price to honor the some contributors, right? And share application money pending allotment also very simple. We collected the share application money for our business, but allotment is still pending. We are not confirmed the allotment as in the year end. So until it is confirmed, it will be appearing as a share allotment money receipt pending. So you know that pending allotment, you know that this will be very rare scenario. So that's why in most of the companies, final accounts, while you prepare, no, you skip this one. Okay. So it's very rare. Once a while, the company may issue the shares, and that too, after the issue, it remains pending to allot for allotment as on 31st March will be available here. Rest will not be come here. Most of the cases, it is missing only. Now, under non-current liabilities, we have 4 items. Under non-current liabilities, we have 4 items. Is that okay? One is long-term borrowings. Another one is deferred tax liabilities and other long-term liabilities and provisions. Usually in liabilities, we have the liabilities and the provisions, right? Here, the liabilities will be of the 3 characters. Another one is provisions. And non-current liabilities are the liabilities supposed to be payable only after the 12 months period, okay? Repayable, payable after 12 months. If it is payable within 12 months, then it is current liabilities. Okay, clear? Now come on, tell me, is the debenture current liabilities or non-current liabilities? Debentures. If the debenture is supposed to be payable within 12 months, then it comes under current liabilities. Hope current liabilities. Okay. So whatever it may be, I issued the debenture and stating that I will buy back only by the end of 5th year. Redemption of debenture possible only by the end of 5th year. 5th year only I go for redemption. Is that okay? But 4.5 years already over. In another half year is there. What does it mean? Within 6 months I have to pay this. Then this non-current liabilities is classifiable as current liabilities. The debenture appearing under non-current liabilities now becomes current liabilities. Hope you will be now able to understand. So number 1, so the liabilities are the 3 characters. One is long-term borrowings, another one is deferred tax liability, third one being the other long-term liabilities. Number 1 being the general long-term borrowings, probably debentures, borrowings, debentures, borrowings. What about the creditors? If the creditors also payable after 12 months, this will be not. Earlier we studied debenture means non-current and creditors means current. No, here it's not so. Whatever it may be, those liabilities supposed to be payable within 12 months will become current liabilities. Those liabilities supposed to be payable after 12 months will fall under non-current liabilities. Hope you'll be able to understand these 2 classifications. And long-term borrowings, and deferred tax liabilities and other long-term liabilities. Those things not falling under A and B will come under other long-term liabilities. Deferred tax liability and deferred tax asset. What does it mean? Okay. You'll study under taxation chapter, according standard for taxation later on. You still have that chapter to be covered. Okay, no need to worry about that. So for your better understanding, I'll just explain what is called TTL. Okay, for example, net profit as per your P&L account being 1000. Okay, but net profit for the taxation purpose, you might have studied the PGVP chapter, right? You do lots of plus or minus with the net profit, what we have arrived to get the profit for the taxation purpose. Probably you may charge around 500 rupees depreciation for the P&L for the asset. But as for the taxation method, you can for section 32 of the income tax. By charging another additional 500 rupees, your profit will decrease from 1000 to 500. Am I right? Your applicable tax rate being 30%. So the depreciation as per the financial accounts being 500 and as per the income tax it is 1000 rupees. That's the reason for additional depreciation to be charged for the profit calculation with respect to the taxation purpose. Because of the additional charge of 500 rupees, the profit for the taxation purpose is lowered by 500 rupees when comparing to the financial accounts profit. Is that okay? As per the financial accounts profit, if you apply the tax rate, how much you have to pay? 300 rupees will be the tax you have to pay. But for the taxation purpose, only 500 rupees is the net tax, net taxable income. For the 500, if you are calculating 30%, then 150 will be the tax you pay. 300 rupees you supposed to pay as per your income financial accounts profit, but for the taxation purpose, you calculated the profit for taxation purpose and came to know it is only 500 rupees. For 500, 30% is 150 you supposed to pay. Is that okay? Now, come on, tell me, what about this 150? Is it savings or not? Savings or not? Huh? Savings or not? Is it a permanent savings or temporary savings? For example, the asset being 1000 rupees. Under financial accounts, we debited 500 rupees in this year. Another 500 rupees can be debited in the next year. But in case of income tax, the entire 1000 debited in the current year itself, but nothing will be taxable in the next year, deductible in the next year. Am I right? See, you follow the depreciation as per the Companies Act for financial accounting report. Okay, financial accounting purpose, Companies Act like. But for the taxation purpose, you follow the income tax rates. Those rates are totally different. Okay, anyhow, the ultimate depreciation will be only to the value you paid for the purchasing the asset only now. The asset value is 1000. Under income tax purpose, you depreciated 100% every year. The very first year you depreciate 100%, next year you don't have any amount to be depreciated. Scrabble is 0. How can you depreciate in the next year? But in case of financial accounts purchase, 50% depreciated in this year, next year another 50%. So if you go for the next year, income tax, the net profit as per the financial reports being 1000, but for the taxation purpose, it may be 1500. For the 1000 rupees, 30%, 300 rupees you have to pay. For the income tax purpose, for 1500, at the rate of 30%, 450 you have to pay. So naturally, what happens? You paid 150 lesser in this year, supposed to be payable in the next year. So the amount you are paying to the government for the taxation is lesser in this year. Anyhow, you have to repay this in the later period. The amount supposed to be payable later period means what is that? Outstanding liabilities. So this 150 is not considered as your revenue. This 150 is the amount supposed to be payable later on. Otherwise, it is outstanding liability. Outstanding tax liability. This outstanding tax liability is called the deferred tax liabilities. So in the next year you will pay. So what is journal entry for the first year? The journal entry for the first year being income tax paid account debit, DTL account debit to bank. So how much you pay? Sorry. Income tax account, you're supposed to pay 300 rupees as per your financial accounts calculation, but you pay how much? Only 150, and another 150 will be your DTL. In the next year, 300 is your tax liability. So income tax account debit 300, and to bank, how much you have to pay? You have to pay 450 for the taxation purpose. It means that 150 DTL is now paid. Okay, when you are paying less than the actual tax as per your financial report, then it is called DTL. Later on, anyhow, it's going to be readjusted. It's going to be readjusted. Hope now you'll be able to understand the DTL concept here. Anyhow, we'll have a separate chapter for that. You'll be able to understand much better in the later classes. So, any amount you're supposed to pay to the government for the adjustment of DTL in the subsequent period, payable after 12 months will be DTL under non-current liabilities. Payable within 12 months, then it will come under current liabilities only. Is that okay? Now, 4 items are there. Among the 4 items, 3 are liabilities, 1 is provision. So, long-term borrowing, DTL, and other long-term liabilities and provisions. In case of current liabilities, ditto, it will come here. Okay, we have 4 items here. First one, long-term borrowing. Here it should be short-term borrowings. Last one, provisions. Here also provisions. Here other long-term liabilities. Here other current liabilities. But we don't have the DTL. It will be simply trade payables. Creditors and bills payable. Hope you'll be now able to understand the items available in the balance sheet. items available in the balance sheet. Clear? Come on, join with me. Once again, let's start this. One is shareholders' funds. Another one is share application money, pending allotment. Third being non-current liabilities. Fourth being current liabilities. Payable after 12 months will come under here. Payable after within 12 months will come here. And here we have share capital, resource and surplus, share warrant. Usually you don't get the share warrant and this one also. These two will come rarely. Under non-current liabilities related to the current liabilities, three items are there. One is for provisions. So long-term borrowings, other long-term borrowings, and long-term provisions. Here we have the DTL. Here also we have four items. Leaving this, rest will be the same, like long-term borrowings becomes short-term borrowings and other short-term borrowings, and here short-term provisions. Here you can replace with the trade payables, creditors and bills payable. Clear? These are the items, components are there in your equity and liabilities, especially shareholders, funds and others. Then how about the assets? In case of assets, okay, second block, assets. We have two major blocks. Number one being non-current assets, number two being current assets. Number two being current assets. Is that okay? Now, let's see what could be there in usually current assets. Stock, after sale, if it remains pending to be recoverable debtors, after you receive, this will be cash. The same order will be here. The same order will be here. What are they? Stock, otherwise inventory, and trade receivables, and cash. Apart from that, some more items are going to be includable, which is nothing but current investment. Investment supposed to be encashable within 12 months will be called as current investment. And here, short-term loans and advances. Short-term loans and advances. We have given the loans where we'll get it back within 2 or 3 months. That's called short-term loans and advances. Right? Even others. Those not falling under this one. So the three are predominant. Majority cases you will have the three. What are they? Stock, trade cash, trade receivables, and then cash. Debtors and BR. Debtors and BR. Here cash represents all the short-term, most liquid form of assets, like short-term, short notice. Within a short notice, matter of 12 months, 12 hours or 13 a week's period, you get money, then that will come under cash. Okay. T-bond, treasury, government bond, and all these things where you can encash it, matter of 12 hours or maximum 2 days or 3 days. If you are able to get, then that will also coming under cash. So it means cash, bank, and marketable securities. Marketable securities. All these three will be called as cash and cash equivalents. Cash and cash equivalents. And current investment, short-term loans and advances, other current assets. So usually you come across with these three, and you better keep these points also in your mind. In case of non-current assets, predominant one being the fixed asset, right? So property, plant, equipment. We don't call currently this is fixed asset. It's property, plant, and equipment. Under property, plant, equipment, we have two items. Okay, two items. One is tangible, another one is intangible. Okay, so what is that? Tangible assets and Another one is work in progress of this. Here intangible assets and work in progress of intangible assets. You cannot say intangible assets of work in progress, the work in progress of intangible assets, but intangible assets under development. This is under development. That's how you can use a term. So under plant equipment, we have four items. Predominantly only two. One is land and building or plant and machinery. Land and building is the finished state. If the land and building is under construction, then it's called capital work in progress. Similarly, patent we applied and got it, then it is intangible assets. And we are in the process of developing the patent and supposed to get it approved. So in that process, then it is also intangible assets, but under development. So these are the four components. And thereafter, B, C, D, E. Four more items. Here non-current investment, similarly here non-current, here current investment, here non-current investment. Deferred tax asset. Okay, in liabilities we have seen deferred tax liabilities. Here we are going to study deferred tax asset. Okay, and long-term loans and advances and other non-current asset. So you forget about that. Rest will be automatically fall under this. Non-current investment, short-term loans becomes long-term loans and advances. Other current assets becomes other non-current assets. Instead of this place, we have deferred tax assets. That's how you can easily group it. So the way how I'm guiding you is to make you easily remember the structure. Okay, that's why I'm putting the words in this way. Okay, let's again re-summarize. Block 2 assets block, vertical format, block 2 asset format. Number 1 non-current assets and number 2 current assets. Under current assets, what we had to understand: inventory and trade receivables and cash equivalents. Here current investment, here short-term loans and advances and other current assets. You just consider this as a separate block. A, B, C, D, E, F. You now write the same here. How? Current liabilities becomes, current investment becomes non-current investment, and this one becomes deferred tax asset. This will remain as it is. Long-term liabilities and advances, loans and advances, other non-current asset. Hope you'll be now able to understand. And apart from that, A. This is B, C, D, E. Very simple. In A, property, plant, equipment. In property, plant, equipment, we have tangible assets, intangible assets. In case of tangible assets, work in progress, and in case of intangible assets, work in progress, otherwise under development. So that's how you can easily remember what are the items will fall under the statements. Now, before I go for the income statement, let me try to finish off some additional theory and questions related to financial report. Okay, financial position. Yes. Under what headings will you show the following items in the balance sheet of your company? Sinking fund, patent and copyright, unsecured loans and unsecured loan only. So sinking fund is nothing but reserve. It will fall under reserves and surplus. Patent and copyright, non-current assets, under that intangible assets. Unsecured loan, okay, unsecured loan, non-current liabilities, provided if the loan is repayable after 12 months. If it is repayable within 12 months, then it becomes current liabilities. Loose tools, will be inventory. Current asset, under current asset, inventory. Okay, so in inventory, what are the items will be there? Raw material stock, work in progress stock, finished goods stock, and loose tool stock. All these things will fall under inventories. Okay. Mortgage loan, usually nothing stated, it's a non-current liabilities only, non-current liabilities. Okay, under that long-term borrowings, or simply put the value being the mortgage loan. Interest accrued but not due on loans, interest accrued but not due. Now this will be, what is this? Interest accrued but not due on loan. Come on, tell me, what is the difference between outstanding interest as well as interest accrued but not due? What is the difference? So X company issued the debentures, 12% debentures, face value being 100, debenture holders. The issue dated on 1/1/2025, okay, or 2024. Clear. Stating that interest is payable 1st January of every year, and tenure of the debenture being 20 years. So X issued the debentures face value of ₹100. Interest on that will be payable on every January 1st. For how many years? 20 years. After the 20th year, it is going to be ready. If you are going to prepare accounts for 1/1/2024 to 31st March 2025. Okay, come on, tell me. When will you pay the interest? Every Jan 1/4/24 to 31st March 2025. You pay the interest on 1/1/2025. How much interest you will be paying? For 100 rupees, 12%, 12 rupees interest is payable. That 12 rupees interest is for this period. 1/1/2024 to this period. 12 rupees. This 12 rupees, where the 3 rupees is for this period, 9 rupees is for this period, 3 months and 12 months. And as on 31st March 2025, interest is not going to be repayable. It's not going to be payable. It is going to be payable only in the next Jan. But from that date to this date, 3 months is already over. For the 3 months, there is an outstanding interest, 12% for 3 months. 3 rupees interest is there. This is not paid. Is it payable? Definitely it is not payable, because as per the agreement, I'll pay the interest once in every year. I'll pay only in the next period. But anyhow, this interest is accrued. As the interest is accrued, due date has not come. That is why interest accrued but not due. Not due. Due date has not come. Okay. Even after the due date, if you have not paid, then it is called outstanding interest. Due date not come, but amount is accrued, then it is called accrued but not due. This amount, this 3 rupees, remains outstanding interest like, but slight difference. It's not pure outstanding interest, it is accrued but not due. But anyhow, this will be payable within 9 months. In the next 9th month, 1st January 2026, it should be payable. So if it is supposed to be payable within 12 months, then it becomes what? Current liabilities. Current liabilities. Is that clear? Next, public deposit. So company will get the deposits from the shareholder, means the investors also. So the company can raise the fund by issuing the shares, issuing the debentures. Sometimes the company gets the money by way of collecting the deposits. Also possible. If nothing stated, the deposit will be repayable only after 12 months. So non-current liabilities. Okay. This will be a long term only. This will be a long term only. Clear? This was the question, very initial period was asked in the exams. In the initial period, the basic questions from the format only asked. Nowadays, they have incorporated additional sums also. probably they included the adjustments and complicated. Okay, the year beginning when we started having this in our chapter, just answer me and it carried 4 marks. Now what happens, you have to prepare completely. See, these are the questions we were asked earlier days. I could still remember in CMA, couple of years ago, they asked to prepare only the financial statement, financial position, the balance sheet format only for 8 marks. Only format. Okay. So now what happens, you have to prepare the illustrations. See, the question number 1 is the financial report, especially balance sheet. Question number 2, you have to prepare, I think, P&L account as well as balance sheet. Question number 3 is also some advanced sum where we have the adjustments. If you know normal final accounts, okay. Additionally, you have to understand the accounting standards to incorporate the format. That's all. Okay, it's not a separate chapter. Yes. Name 4 items which are required to be disclosed under the head inventories as per skill number 3 disclosure requirement. What are the 4 items? Raw material, work in progress stock, finished goods stock, and loose tools. Now, money received against share warrants. Money received against share warrants should be shown under shareholders' funds, third item like. Okay. Shown as a separate line item in balance sheet. Separate line item in balance sheet means when you see the balance sheet in the very first page itself, there will be a line for this item. C. Can you know what is the equity shares and preference shares here? In share capital, you are not aware about that. So they will give a note number 1, and in note number 1, equity share capital, preference share capital, under equity share capital fully paid up and equity share capital partly paid up. All the details are given in notes to accounts only. Okay. And when it's all about money received against share warrant, don't state this. A part of this one, share money received against share warrant. If you show this, this is not accepted. Because in the very first page itself, there should be a line for this money received against share warrant. If you are able to show as a separate line in the very first page, don't go for the next page to compare whether there is any detail in workings available for that or not. You have to get the details. That is called line item. That is called line item. Is that okay? So here's a line. How many lines are there? These are the lines. These are the lines. Okay. So similarly here, this money received against share warrants shown as a separate line item in balance sheet. In case of listed companies, share warrants are issued to promoters or others in terms of the guidelines for the preferential issues. Okay. So it may be issued that share warrants are issued to the promoters and others as a preferential issues because of their exemplary contributions given for done for the company. And this is also as per its SEBI guidelines. Share warrants ultimately form part of the shareholders' funds. It's only currently option like it will be converted into shareholders' funds later on, equity share capital. It will be converted into equity share capital later on. Since the shares are yet to be allotted against the same, these are not reflected as a part of share capital. It is not being the share capital. You now have the coupon. You have to convert the coupon into the share capital later on. No, until that period, it remains coupon only. The coupon is now share warrant. I have given the coupon to purchase probably a TV from a showroom. The TV may be 50,000 rupees, but the coupon is only 10,000 rupees. I give this coupon for 10,000 rupees. Okay, you can go and convert your coupon into TV. So you are going to save around 40,000 rupees, pretty happy. But when you are having the coupon in your hand, it is not TV. The moment you hand over to the shop and convert this into the TV, then it becomes TV. The same happens, share warrant remains a coupon like. The moment it is converted into equity share capital, it will be forming part of the equity share capital. Until that period, it is a share warrant only. Is that okay? But it's a separate line item. Clear? Money received against the share warrant. Now, share application money pending allotment and treated as a separate line item after shareholders' funds but before non-current liabilities. Isn't it? After shareholders funds, before non-current liabilities, it should be shown as a separate line item. Okay. See, the company planned to issue 1,000 shares of rupees 100 each. But application money received is for 1,500 shares into 100. Okay. You're pretty sure what you're not able to allot the shares beyond the company proposes to issue. The company proposes to issue only 1 lakh rupees worth of share, but they have collected 1 lakh 50. The additional amount they have collected, what happens for this? Excess application money is supposed to be rejected and refundable. This is refundable. Am I right? The company can issue only to this extent. 1,000 into 100. Only this much can be issued. Only this much can be issued. 1 lakh. Now, this will be shown as separate line item after the shareholders funds and before the non-current liabilities. In case supposed to be refundable, it is not anyhow converted into share capital, will be shown where a part of current liabilities. Okay, if share application money not exceeding the issued capital to the extent non-refundable. So the company planned to issue only 1 lakh, but we collected 1 lakh 50,000 rupees worth of share money from the investors. But anyhow, I am able to issue only to the extent of company proposed to issue, which is 1 lakh. Another 50,000 anyhow is going to be refundable only, no? So here you see cases treated as other current liabilities, where this one. If the company issued capital is more than the authorized capital, and approval of increase in authorized capital is pending, we are not able to allot anyhow. The amount of share application money received over and above the authorized capital should be considered as other current liabilities because it is going to be refundable in a short duration. And share application money to the extent refundable, this one. And calls paid in advance, including interest accrued on it. Okay, calls paid in advance. Share application money received along with the call money also. Okay, the price may be 100, but we are collecting in installments 30, 40, 30. Mr. X paid all the 100 rupees along with the allotment money itself. So only 30 will be considered as share application money pending allotment. Remaining 70 will be called calls in advance. This will be forming part of the calls other current liabilities. Okay, until it is going to be converted into share capital, it's not share capital. In 3 scenarios, share application money will not appear in the share application money pending allotment. That will go to the other current liabilities. What are they? If the money received beyond the authorized capital, where the authorization is still pending in that case. Another one is excess amount is supposed to be rejected and refundable that amount. Third one is the investor paid the call money in advance itself. That is also not part of the application money. It should be kept under current liabilities only. That to other current liabilities. Hope you'll be able to understand. Now, cash and cash equivalents. Cash and cash equivalents. Cash and cash equivalents. See, what is called cash and cash equivalents? So I already told you it's not only cash. Cash, bank, and marketable securities. All these things put together will be called as cash and cash equivalents. Balance with the bank, even checks, drafts on hand, cash in hand, and others. If all these things are very, very liquid state, you can use it immediately. Or matter of 2 or 3 days, you can convert that into the cash. And all these things will come under cash and cash equivalents. Provided you have to give the notes. Okay. Earmarked balances with banks shall be separately stated. Balances with the banks to the extent held as margin money or security against borrowings. And if there is any repatriation restrictions, okay, in respect of the cash and bank balances shall be separately stated. And bank deposits with more than 12 months maturity shall be separately disclosed. Is that okay? In your balance sheet, equity and liabilities, and the second one being assets. Under that, non-current assets, current assets. Under current assets, you have cash and cash equivalents. Okay, I explained that in note number 1, cash and cash equivalents. So bank balance here, cash we have 100,000 rupees, bank balance we have around 500,000 rupees. Is that okay? Now, some deposits. See, you think how much cash you have? 600,000 rupees you have the cash. 600,000 you have cash. You are in need of 300,000 rupees immediately to spend. What will be your position? You will be pretty happy. You have 600 rupees cash. For the immediate settlement, you are in need of 300 rupees. You can manage. You have 100 rupees in your purse, 500 rupees in GPay account, bank account. You can use 600 rupees easily, isn't it? So if you go for a shopping, you need to spend 300 rupees. What happens? You can use 100 rupees safely from your cash, another 200 rupees GP. No problem. No problem. Is that clear? But what happens, the banker says minimum balance 500 rupees. Will you go for shopping or not? Though you have 600 rupees, now you are in trouble. You cannot purchase 300 rupees worth of commodity. Only 100 rupees you have. Yes, of course, 500 rupees there in the bank account, but minimum balance is there. If you use that 500 rupees, there is a penalty of 100 rupees. You don't purchase. The same happens if a company says, I have 500 rupees. Now the question is it readily available for using for usage of payment? No, sir. Why? Already company announced the dividend. Once the company announces the dividend, immediately the amount equivalent to the dividend payable will be reserved. That money is blocked. That is called earmarking. Unpaid dividend. Probably 150 rupees has gone. You cannot use it. Another money being, you have to guarantee maintain minimum balance of say 50 rupees. You borrow, because of the borrowing, the lender has intimated to you, you should not use another 50 rupees. That's the minimum margin money you have to show. If you want to have a borrowings of rupees 1 lakh, if you go and approach the banker says, okay, I will give 1 lakh rupees is your fund requirement, but you are being the owner, you have to contribute out of your own pocket money some extent, that is called margin money. So you spend around 25,000 rupees, I will give 75,000 loan. So 1 lakh you can do the business. Similarly, to that extent, you have to keep the money as margin money in your account. You cannot use it. And the money is in the bank account with foreign company, foreign bankers. You have some restrictions to bring it to India, repatriation restrictions. The amount available in the foreign bank account to be brought into India will have some problem. That problem is called repatriation problem. Repatriation is nothing but bringing the money from foreign to India. So there's a repatriation problem of rupees 100. Now what happens? 300 rupees you cannot use. Now you can safely use only 100 and 200, 300 only. So you have to give this detail. So while um, presenting your financial statement, cash and cash equivalent 600, apart from that, you have to give the notes to accounts related to all these issues also. Earmarked balances with bank for unpaid dividend, etc. And if you are having this balance for any margin money or security against any borrowings, guarantee, other commitments should also be disclosed separately. If the amount recoverable from foreign country where it is repatriated, the repatriation is restricted, then to that extent you cannot use it immediately. Or you may invest in the bank as a deposits safely. Rather than keeping as a money, you can deposit. So if you are converting that into the deposits, you will get the interest. If you are keeping the money ideally in your current account, you don't get any interest. So you tell them, sir, I convert this into the deposit, sir. Sometimes later I will withdraw. So for the enjoying of small interest benefit, you can convert that into the deposit. But the deposit duration is more than 12 months, then you are not able to immediately enjoy. So you have to show it separately. Hope you'll be now able to understand the cash and cash equivalents and its disclosures. Clear? Let's start with the first illustration for balance sheet only. For balance sheet only. Next illustration will go for the income statement also. Now, share capital, calls in arrear. We have this land, building, plant and machinery, non-current assets, general reserve, resources and surplus, loan from IDBI may be assumed to be the non-current liabilities. Non-current assets, property, plant, equipment. Sundry creditors, current liabilities. Capital redemption reserve will be resource and surplus. Investments, non-current investment, profit and loss, resource and surplus, goodwill, non-current assets, under that intangible assets, cash in hand, debtors and stock. So now we prepare what? Balance sheet, equity and liabilities. Balance sheet, come on, join with me to solve this balance sheet. See, if you are asked to prepare the balance sheet, you can prepare just like that. But you need to follow the structure here, that's all. Okay, equity and liabilities. Under that, shareholders funds. Under shareholders funds, we have three items. Anyhow, we have share capital, reserve surplus only. Okay, money received against share warrants, not required. Application money, share application money received, pending allotment, also not required. If it is not required, you just skip that. Then second one being non-current liabilities. Under non-current liabilities, we have only one item, loan from IDBI. Third being current liabilities. Under current liabilities, we have sundry creditors only. Sundry creditors only. And assets. Assets. Number one, non-current assets. Another, tangible assets and intangible assets. We have land, building, plant and machinery. Three tangible assets, one intangible assets. Intangible assets. Second being property, plant, equipment. Sorry, property, plant, equipment. Then non-current deposit, investment. Second being current assets. Number one, shareholders funds, especially share capital. Under that, we have equity share capital 7,50,000 and calls in arrear. Calls in arrear should be subtracted. $7,45,000. So 7,45,000 here. And second one being the resource and surplus. Under resource and surplus, we have general reserve 50,000, profit and loss 65, capital redemption reserve CRR 20. So what is the total value? 1,35,000. So 1,35,000. And the non-current liabilities, loan from IDBI only we have. The value being 1 lakh. And under current liabilities, we have only one item, sundry creditors. The value being 1,50,000. Under property, plant, equipment, we have the tangible assets 3. So tangible assets, under that we have land, building, plant and machinery. Land 2,20,000, building 2 lakhs, plant and machinery 2,50,000. What's the ultimate value? 6,70,000 rupees. 6,70,000 rupees. And we have goodwill, intangible assets. Okay. 25,000. And investments 6% GP notes. Government note 3 lakhs. Under current assets, we have inventory and debtor or receivables and cash. Inventory 25,000, debtors 1 lakh, cash 10,000. So you have posted all the items. Now finish up tallying this. 11,30,000, 11,30,000. Hope it is now agreeing. Now, part 2 of schedule number 3 is all about preparation of P&L statement. The format for P&L statement is given. We prepare the income statement also in vertical format. All the credit side items will be recorded very first, and later on you are going to subtract the debit side items. Normal P&L account, right? So this will be the income, this will be the expenses. From the income, expenses is subtracted to find out the profit in this case. Profit in this case. Let me explain. The main revenue is nothing but revenue from operations. The intention of starting the business probably for selling stationery. Any revenue generated by selling the stationery will be the revenue from operations. While selling the stationery, if they get some other benefit because of selling some other unwanted assets they have, or the things what is not required for them, they can discard. Because of that, if they get any revenue, that will not come under revenue from operation. That will be falling under other revenue. So you classify this being the revenue from operation and other revenue. Usually, the sales you record in the credit side of the trading account, that will be the revenue from operation. And all the other revenue credit in P&L account, that will fall under other revenue. Income from investments made and dividend received on investments, and temporarily the place remains unutilized, let out for a temporary benefit like rental, also be considered as other income. Okay, other income. Okay. In case of other income, in your overall income, this particular income will consist more than 1% of the revenue or 1 lakh. That should be separately disclosed. That should be separately operation. revenue from operation. Okay, probably 10 lakhs. They get interest from investment. Interest from investment. Dividend from investment. Maybe 1.5 lakhs. 1% of revenue from operation is how much? 10,000. Am I right? But the value is more than 10,000 revenue from investment. So the 1,50,000 rupees you receive from interest by way of interest from investment, that should be separately disclosed. Apart from that, dividend also received. Dividend is 15,000. Other revenue also we have temporary let out and commission, other charges. All these things are 500 each. You can write all this value collectively and put the value being 1,500 or another 500. 2,000 rupees. 2,000 rupees. This will be called as other income. So out of the revenue, if the value is more than 1%, other than this operational revenue should be disclosed separately with its name, and otherwise the value is more than 1 lakh, probably the revenue from operation being say 100 crores. In case of interest from investment is 1.5 lakhs. Do I want to show it separately? 1% and the 100 crore is 1 crore. 1.5 lakhs is nothing but a small penny amount. Yet the value is more than 1 lakh, you have to show this separately, but these things are not required to be shown separately. Hope you'll be now able to understand. Okay, revenue from operations and income. The income being more than 1% of revenue or 1 lakh, then it should be separately stated with its own name for which this income is received. Otherwise, if the number is very small number, then you can group it and show this as other income. This is what about the total revenue. Total revenue. Come on, tell me. How do you find out the GP? How do you find out the GP? In trading account, trading and P&L account or manufacturing account. Opening stock, 1,000. Purchases, 15,000. Closing stock, 2,000. Okay. Sales being 20,000 rupees. How do you get the GP? You subtract this block from sales to get the GP. Am I right? 1,000 plus 15, 16,000 minus 12,000, 2,000, 14,000. This 40,000 is subtracted from 20, so 6,000 is the GP. Am I right? But under vertical format, see, very interesting. Expenses. This is revenue. You are going to subtract the expenses from here. Under expenses, raw material purchased. How much? 15,000. Changes in stock. If the closing stock is increasing than the opening stock, it's a revenue. Okay, it's a revenue. So minus 1,000. Minus 1,000. Otherwise, the changes in stock is nothing but opening stock minus closing stock. 1,000 minus 2,000 minus 1,000. 14,000 ultimate value, what you have is nothing but what? Cost of material sold. Cost of material sold or consumed. This is called cost of materials consumed. Clear? Now, how much worth stock is sold here? Opening stock plus purchases minus closing stock. 1,000 plus 15,000, 16,000 minus 2,000. 14,000 rupees worth of stock sold for 20,000 rupees. We made a profit of 6,000. But it is stated in a vertical format here. Okay, cost of raw material consumed or material used. How? Material purchased, adjust for the changes in stock. Adjust the changes in stock, opening stock minus closing stock. If the opening stock is higher, naturally what happens? It's a plus item. If the opening stock is lower, the item being subtracted. So the ultimate value being 14. Clear? Hope you will be now able to understand this one. This will be for what? Raw material, finished goods, as well as work in progress. You will have the opening stock of raw material, opening stock of work in progress, opening stock of finished goods for all, isn't it? So if you are being the manufacturer, you will not have only the finished goods stock. You may have the raw material stock, finished goods stock, work in progress stock. You have to do the same operations for all the three. Changes in opening stock between the opening and closing, changes in the finished goods stock between opening and closing. But what about the work in progress, sir? Usually, work in progress is skipped. Okay, unless huge change, if you notice, unless huge change is noticed. Clear? So, for example, over tank you have and the pipeline, and here is a tap. Here is a tap. Okay, you have the bucket here. The water here is the raw material. The water in your bucket is the finished goods. The water in this pipeline is work in progress. Come on, tell me. Here the stock may be changing. Here the stock may be changing. What about the stock available in this pipeline? That remains the same. More or less same. Year beginning also same value. Year end also same value. If you are preparing any food, probably using the 1 liter capacity cooker, how much of food you can prepare every time? Only 1 liter. Means in that process, it will be capable of producing only 1 liter. There will not be any change. Okay, if I ask you morning, how much you are having in your cooker for preparation of food? 1 liter. In the evening, 1 liter. But the finished goods may be totally different. So that's why in case of work in progress, not required if the change is insignificant. Most of the cases. Okay. Hope you will be now able to understand this concept. So under expenses, cost of material is the predominant one, where raw materials purchases. With that you have to do plus or minus with respect to the changes in inventory. That too, if the change is exorbitant, usually work in progress will not be recorded because the value is usually insignificant. But if you find this value is also significant, then you can show. Otherwise, you don't need to show. Then what other things are required? One is material, another one is employee benefit. Employee benefits. Another one is you need to borrow money sometimes, so finance cost. Another being amortization and depreciation of the capital assets used. And finally, expenses. Expenses and other expenses, similar to the other revenue. So predominant expenses being material, labor, and interest, and asset used. Due to the asset usage, the value of asset may be decreasing. That is also cost named as depreciation amortization. Apart from that, we may have n number of other expenses. Provided if the expenses is very insignificant value, group it and post this as other expenses. If the value being more than 1 lakh or more than 1% of the revenue, you show it separately with that name. Is that okay? E. That's all. Now, this will be the total expenses. If you subtract the revenue from total expenses, you'll get the profit. You'll get the profit in very simple sense. In very simple sense. But when it is all about a complete setup of part 2 of skill number 3, that profit is again going to be distributed or allocated into 3 different blocks, segregated into 3 or 4 different blocks. If you are clear with this, let me know so that I will go for the next segment here. Are you able to understand this one? Make it faster. Now, the difference between revenue and total expenses is the profit in general, but here this will be named totally different. Totally different. Profit before exceptional and extraordinary item. Exceptional item and extraordinary item and tax. You might have heard about the term profit before tax, isn't it? But here, not only profit before tax, profit before exceptional item and extraordinary item and interest. Then from this, it is very clear. First, you have to subtract exceptional item. Next, you have to subtract the extraordinary item. Next, you have to subtract the interest component, tax component to get the profit after tax. Clear? Now, I'll start with subtracting the exceptional item. Exceptional item. What is called exceptional item, sir? Usually the revenue being 10,000 rupees. Due to some market scenario, we got around 1 lakh rupees for the same commodity. Surprise, right? Okay. So during the COVID, the probe to check whether oxygen level of your body is correct or not, there's a probe, right? Heard about that. Oximeter. So I purchased around 3-4 oximeter during our days, the tough period. One oximeter came around 2,800 and roughly I purchased around 1,900 or 800 to this range. All the three. Averaging around 6,000 rupees for all the three. After the COVID, 1 year later, I just re-verified what is the price in the market. It is only 200 rupees per probe. So the income generated by them is exceptionally high. It's not regularly possible for all the occasions. All students pass, whether you study or not, during the COVID scenario. Exceptional case. If there is an exceptional case, because of that, if you generate any revenue, because of that, any loss happen, should be shown separately. That is called exceptional item. Extraordinary, which is not usually happening in your organization or practically, like earthquake happened and subsidy given is taken by the company, government back. Those things are extraordinary. Many will study that later on along with the accounting standards. So you have to subtract the exceptional item. Then the value what you get is, come on, profit before extraordinary item and tax. Now you have to subtract extraordinary item. You'll get profit before tax. Then you have to subtract tax. The tax may be current tax and deferred tax. Deferred tax liabilities and asset, you have to adjust that. You'll get what? Profit after tax. Hope you'll be now able to understand this one easily. So profit before tax, instead of that, we have two more elements here. One is exceptional item, another one is extraordinary item. So profit before exceptional item, extraordinary item, and the tax is calculated. From there, exceptional item is subtracted. Profit before extraordinary item is arrived. From there, extraordinary item is subtracted to get the profit before tax. From there, tax is subtracted to get the profit after tax. Again, in your organization, you have 4 divisions. You're supposed to plan to close one of the divisions, seems to be non-profitable. A, B, C, D, 4 divisions you have. The division D has no profit, or the profit is gradually decreasing. Sometimes later it will definitely fetch you loss only. Why do I want to then bother about running the division D? So slowly I put my importance of running this is reduced. Matter of 3 or 4 years later, I plan to discontinue the division D completely. In that case, I had to show the profitability of the division D separately, profitability for the remaining ABC division separately. That ABC 3 divisions profitability will be called as profit from the continuing operations. The D is considered as profit from discontinuing of not discontinued. Supposed to be discontinued matter of 3 or 4 years later. Discontinuing operations. So here profit or loss for the period from continuing operations and discontinuing operation. Okay, you can get these two, and then finally you'll get the profit and loss ultimately. Here we have two options. One is continuing operation, another one is discontinuing operations. Finally, you have to find out the earnings per share also. The earnings per share may be basic as well as diluted. Basic and diluted. Okay, you'll see what is called basic and diluted later on along with the EPS chapter, not now. Okay, you have the earnings per share chapter. There you learn all these things. See, you can see the financial report of any listed company. So we'll start with the TCS. Okay. Now for any company, you can see the financial reports. See, income statement. How is the income statement? Sales, other income, total expenditure, EBIT, interest, tax, then net profit. It's a condensed version. So they have to give the balance sheet, share capital, resources, surplus, current liabilities, other current liabilities. If they don't have any item, they can skip. Okay. Cash flows and ratios. Mm, I need the complete financial reports. I could not search now. Okay, anyhow, you can go and see that later. The points what we have covered here will be required to be presented by all the listed companies. Now, come on, we'll try to solve on illustrations where we have the income statement also a part. Question number two. Question number two. Land at cost, non-current assets, plant and machinery at cost, non-current assets, trade receivables, current assets, inventories, current assets, bank current assets, adjusted purchases. When the term adjusted purchases is given, it means opening stock and closing stock already adjusted with that. That's how you can understand. So this is the expenses and factory expenses, administration, selling and distribution expenses, debenture interest. These are the expenses and debenture interest, finance cost, interim dividend paid, appropriations, equity share capital, shareholders' funds, debentures, non-current liabilities, general resource and surplus, profit and loss, securities premium or the resource and surplus, sales revenue from operations, trade payables, current liabilities, provision for depreciation account. I'm not sure what is suspense account here. There may be some error or there may be some adjustment required. Authorized share capital of the company is 40,000 shares of rupees 10 each. The company, on the advice of independent valuer, wishes to revalue the land at 3,60,000. They want to revalue the land at rupees 3,60,000. What is the current value? 220. They want to revalue at 360. That's an appreciation by 140. Declared final dividend at the rate of 10% over interim dividend. Already interim dividends 80,000 is paid. Final dividend 10% is also be declared. Out of 300, final dividend 10% means 30 rupees would be payable. Okay. Suspense account of 4,000 represents cash received for the sale of some of the machinery on 1/4/2017. The cost of the machinery was 10,000 and then the accumulated depreciation thereon being 8,000 rupees. What does it mean? One of the machinery was sold for 4,000 rupees. Immediately they recorded that as money recovered. So the entry being bank account debit to suspense account. The value being 4,000 rupees. What is the correct entry? Bank account debit 4,000 rupees to machinery account. What's the value of the machinery? 10,000. We sold the machinery. Already there's an accumulated depreciation on that being 8,000 rupees to provision for depreciation. 10,000 is the original value of the asset. Accumulated depreciation on that being 8,000 rupees. 2,000 is nothing but written down value. Sold for rupees 4,000. So you sold this asset for more than its WD value by 2,000 rupees. That 2,000 is nothing but profit on sale. Is that okay? So to profit on sale. Profit on sale being 2,000 rupees. Now, instead of passing this entry, they simply pass the entry being bank to suspense. 4,000 came in, they added the 4,000 with the bank and temporarily kept that value in the suspense account. Now we are going to adjust this rectification entry like. Now what happens here? Bank account is okay, but correct entry should be passed and this wrong entry should be reversed. This wrong entry should be reversed. Okay. Suspense account debit. Provision for depreciation account debit to machinery to profit on sale. 4, 8, 10 and 2. Am I right? So you have to incorporate that. You have to incorporate this. So by incorporating, I assume this suspense is being the credit. Because of this one, it becomes 0. Provision for depreciation already we have 172 by debiting 8 rupees. Now it is 166. Machinery 10 rupees is going to be removed, 760. And profit on sale will be a part of profit only. So 72 becomes 74. Otherwise 72, I can post new account like 72, 74, profit on sale. Profit on sale. Hope now you'll be able to understand how to adjust this. It's only a rectification of error entry like. Now, depreciation is to be provided on plant and machinery at 10% on cost. So, depreciation. Provision for depreciation 166. In this year, you have to add 10% on cost. SLM method is followed. You are required to prepare Omega Limited's profit and loss statement for the year ended 31st March 2018 and then balance sheet on the date in accordance with the Companies Act 2013 in the vertical form. along with the notes to accounts, ignore previous year figures and taxations. So we'll prepare balance sheet and profit and loss account. Yes, balance sheet, profit and loss statement. This will be part 1 of schedule 3. This is part 2 of the schedule 3. You can name that one also in your exams, in your answer sheet. So I have incorporated all these things here itself, so I no need to refer the adjustments hereafter. Let me start with this one now. Now, equity and liabilities. Under that, shareholders' funds. You have share capital, reserves and surplus. Share warrant, rare, as well as share application money received against pending approval also. Allotment is also rare. Directly go for non-current liabilities. Do you have non-current liabilities anyway? So we have not, yeah, of course, debenture is there, so non-current liabilities and current liabilities total, and second being assets. Under assets, non-current assets, current assets total. In P&L account, you start with what? Revenue from operation, other income. Predominantly these two will come, and this is total revenue. Fourth one being the expenses. In the fourth one, adjusted purchases. Adjusted purchases is nothing but purchases plus changes in stocks. And other expenses, okay, finance cost, and asset depreciation, labor cost. Do you have any labor cost? Wages and other expenses. Other expenses. This will be the block. Total expenses. Profit before tax. Profit before tax becomes profit after tax. We don't have tax because tax is ignored. Okay. The difference between total revenue and total expenses. We'll start with the land 220 in the year beginning. Plus or minus for appreciation and depreciation 140 plus, closing value being 360. This is for land. Similarly, plant and machinery 760, originally 770, 10 rupees worth the plant and machinery sold. You can subtract that one also, no problem. 770 minus 10 minus 10. Then trade receivables will come here. Inventory, trade receivables, cash. We have been given the inventory being 96 and inventory being 86. This is closing inventory, right? Closing only, no, yeah. Closing inventory appearing in the trial balance will go to the balance sheet only. If it is being the open inventory, you have to do adjustments. Bank 20, adjusted purchase 320, factory expenses, admin selling expenses 120. You better have the small notes to accounts and write there and put the value 120 here. Okay, 60, 30, 30. Debenture interest is the finance cost. Interim dividend paid will be subtracted from here, interim dividend. This is only appropriation. Profit available for the shareholders, from there you have to subtract this 18 rupees. Not only 18 rupees, one more value is also proposed. Okay. What's the proposed value? 30 rupees. So, interim dividend and proposed dividend. 18 and 30. The proposed dividend is a forming part of the current liabilities and provisions. Is that okay? Currently, it is only proposed. How much is that? 30 rupees. Am I right? I'll subtract here 30 rupees. Proposed dividend. I'll discuss that later on. So we have completed what? Debit side items. Now let me finish up the credit side items. Equity share capital 300. You have to give the full details in the schedule. 10% debentures forming part of non-current liabilities. The value being 200. And general reserve, all these things are here. So, reserves and surplus, another GR being 130, profit and loss being 72, securities premium 40, sales 700, which is the main revenue, trade payables 52, and provision for depreciation 166 in the beginning, 172, after subtraction it is 166. This year you have to create another 76 rupees. For the original value 10% will be provided in this year. 76 will be the depreciation amount for this current year for the remaining assets. Then suspense account was totally eliminated. Profit and sale of the asset being other income 2 rupees. Other income being 2 rupees. Now 220 becomes 360, 760 minus 166, and another 76 should also be subtracted. What is the ultimate value here? Hmm? 518. So 8 rupees, if I subtract 8 rupees, what is the value? 164, sorry. 164. Yeah. So I change this 164 and 76. Both will be subtracted. What is the ultimate value? 520, am I right? So then the total non-current assets in this case being property, plant, equipment, tangible assets 880. So non-current assets being 880. Clear? Now, total revenue being 702, expenses 320, 20, 76, 160. We don't have wages here. Total expenses being 500 36. Come on, subtract the total expenses from the total revenue. 166 will be the profit before tax or profit after tax. Now, here you can skip the proposed dividend calculation. From 166, if I subtract 18 rupees, 148, that can be transferable here. Profit and loss from the current year. This is previous year balance, this is current year balance, 148. You can add up these two. And what is the total of resource and surplus? What is the value? Hmm? 390. And this 76 was posted, this 140 revaluation resource should be posted, right? I include that one also. Depreciation of plant and machinery was charged to the expenses account, but land value is inflated by 140, you know, that is called revaluation profit of land. The value being 140 is also added. Come on, what is the ultimate value? 530. So this will be 530. Proposed dividend, you can skip this, 52. And come on, total the share means equity and liabilities here, 1082. And asset side total being 1082. Question number 3. ABC Limited provides the following trial balance as on 31st March 2017. So we have been given the closing stock, depreciation rates and all. Closing stock being 3.5 lakhs. So I will mark here itself opening stock and closing stock being 3.5 lakhs. Depreciation for motor vehicle, machinery and land and building. Motor vehicle 10, machinery 20. 10, machinery 20, land and building 5%. Miscellaneous expenditure includes 20,000 as audit fee. So audit fee in this being 20,000 rupees. Interest on debenture is payable quarterly, and then the last quarter's interest yet to be paid. Interest accrued. Okay. Outstanding interest for the last quarter. 3 lakhs for 10% will be payable on 3 lakhs 30,000 rupees. Quarterly means 7,500. That 7,500 remains outstanding. Last quarter interest remains outstanding. Trade receivables include a sum of 25,000 due from Mr. X, who has become insolvent, and only 25 paise rupee is expected to be recoverable. Then automatically what happens? 0.75 PDD will be provided on this. Okay. So 5 and 6. 5 and 6. I'm going to incorporate this one in debtors. That's the debtors. Yeah, trade receivables here. The trade receivables being 10 lakhs. Out of this, 25,000 belongs to 25 Mr. X. Balance 9 lakhs 75,000 could be recovered from the others. On this, only 25 paise in the rupees expected, and provision for doubtful debts required being 75%. Come on, how much is that? 75%. 18,750, and on the remaining value 2% can be calculated. Come on. Huh? 19,500. So the overall PDD requirement being PDD being 38,250 required. Clear? 5 and 6 is also over. And income tax 1,50,000. Yes, now we can prepare all the ledgers and financial reports as well as income statement and this one. Okay, financial position statement, both will be prepared. Yes, come on. Finish up preparing the financial statements first of all. Profit and loss account, profit and loss account, and balance sheet. This will be part 2 of schedule 3. This will be part 1 of schedule 3. Revenue from operation, other income, and total revenue, and the expenses. Under that, purchases, changes in stock, direct wages or wages, employee cost, and then finance cost, capital assets cost, depreciation and amortization, other expenses. Okay, write along with me. Don't simply listen. You have to recollect all these things. Okay, from the total revenue, total expenses subtracted to get the profit before tax minus tax, you'll get the profit after tax. Okay. In case of balance sheet, equity and liabilities, under that number 1 being shareholders funds, reserves and surplus. Second being shareholders funds, share capital and reserves and surplus. Share capital and reserves and surplus. Then second one being non-current liabilities, third one being current liabilities. Now, second block is all about assets, non-current assets, under that fixed assets, property, plant, equipment, non-current investment and all. Second being current assets. Okay. We'll now pick this. Equity share capital being 35 lakhs. Okay, it's better to prepare as a schedule. But anyhow, I just post directly here. 35 lakhs. Debentures 3 lakhs. 10% debentures 3 lakhs. Where 7,500 remains outstanding. Outstanding interest 7,500. This will be a part of finance cost, 7,500. Am I right? Whatever the finance cost paid, with that you add outstanding, you will get the total finance cost. Motor van 4 lakhs and machinery 20 lakhs, land and building 1200,000, and depreciation on these assets being 10% 40, 20% 800, 400, sorry, 400. For the land and building 5% 60. Then overall depreciation being 500. This is depreciation and amortization, so I post this value here 500. Then closing WDV being 400 minus 40. Do we have any provision for depreciation? I think we don't have any provision for depreciation. Okay. So then 360, 1600, 1140. What's the total value now? 1300. Am I right? 1300 will be the assets value now. 3100. Okay. This being 3600 minus 500, 3100. So this is being non-current assets. 3100. Property, plant, equipment. So we have been given what? 12% long-term government securities. This will be 200,000. Sale 60 lakhs minus 3 lakhs, 57 lakhs. So revenue from operation being 57 lakhs. Okay. So I have posted all this item given here. Clear? So let's continue with the next item, interest to carriage outwards. So interest on debenture, finance cost 22,500. We have outstanding 7,500, so total finance cost should be 30,000. Purchases less return 36 minus 4, 32 lakhs. And opening stock 3 lakhs, closing stock 3.5 lakhs, changes in stock being 50,000. Opening minus closing minus 50,000. Minus 50,000. If the closing is increasing, it reduces the cost. If closing stock is decreasing, it increases the cost. So closing stock is higher up, so it reduces the cost. And this one being non-current asset, property, plant, equipment, and non-current investment. So now in current assets, we have the stock inventory. Inventory being 350,000. Okay. 31 lakhs and 2 lakhs. This will be in thousands. This will be in thousands. Only this one. And discount 7,500. Maybe the other expenses like. Under that we have the discount value being 7,500. Carriage outward. Carriage outward can be addable as part of the purchase cost itself, or you can show it separately. The value being 1,50,000. 1,50,000. Clear? Now we'll go for this one. Bad debt, up to bad debt. We'll start with rent and rates, 50,000 rupees. Also other expenses, 50,000 rupees. Income from government securities, 24,000. Other income and trade receivables being 10 lakhs. We have been given the provision for doubtful debts, PDD 38,250. In trade receivables, come on, tell me. From the 10 lakhs, you have to subtract 38,250. What is the net value? 9 lakhs 61,750. Trade payables 2 lakhs. And advertisement 1 lakh 50. Other expenses. Bad debt 20,000. Bad debt 20,000 rupees. Clear? Now 4 more items: salaries, miscellaneous expenditure and all. Salaries being the employee cost 6,72,000. Miscellaneous expenses can be part of the other expenses, 10,000. Audit fee 20,000 rupees. Okay, because total miscellaneous expenses 20 includes audit fee 20. Then other than audit fee, 10,000 will be the miscellaneous expenses. That's how you can break. Okay. Then contribution to PF and gratuity fund also forming part of the employee cost. Any amount payable to the employee will be employee cost only. So you can add here. Cash and bank being 2,22,000. 2,22,000. Here tax provision being 1,50,000. 1,50,000 tax provision and provision for taxation being a part of current liabilities. Provision for taxation 1,50,000. Finish up first P&L account and then you prepare the or finish up the equity and liabilities. The total of other expenses, come on, tell me. 4 lakhs. Okay, 4,45,750 is the total other expenses. So 4,45,750. Now, if I add up these two, 57,24,000 is the total revenue. Total expenses being 48,97,750. If I subtract the total expenses from here, profit before tax here being 8,26,250. PAT will be after subtracting the tax 6,76,250. This will be part of resource and surplus 6,76,250. So we don't have any other schedules. Finish up tallying the equity and liabilities here. The total of equity and liabilities being 48,33,750. The total of assets being 48,33,750. It's now tallying, right? Clear? So with that, company final accounts concepts is completely over. Few more aspects are going to be covered so that this chapter will be completed. Now let's deal with the payment of dividend case. The payment of dividend you might have studied in detail in your company law paper. Okay. So you have to find out the profit for the dividend distribution part first of all. From that, dividend will be payable here. Okay, it's purely company law. Anyhow, I may try to finish up this illustration here. Now, payment of dividend. Dividend is the distribution of divisible profit, but such distribution may entail release of the assets. Okay, while distributing the dividend to the shareholders, asset may be used. So the dividend includes interim dividend also from the company shareholders. The dividends are going to be distributed from the company. Dividend is distributed. While distributing the dividend to the shareholders, you have to use the current year's profit. That too after the subtraction of the depreciation. If this current year's profit after the depreciation is not sufficient enough to pay the dividend, then previous year's accumulated profits can be used. Accumulated profit even only after the depreciation of the previous years. You have to use this first of all. If it is not sufficient, you can use this one. Or you can use the both. You can use the both. And last one being the any state subsidy given by the government can also be used for distribution of dividend. Okay, this is the last shot. Especially the last one, government will give the subsidies, right? The government may give subsidies now and then for the companies for purchasing any assets, for investing in some other new business. Okay, not only that, in some cases, revenue compensation subsidy may also be given. If the company operates, okay, with huge margin, the sale price of the commodity is also very high, then there will be lots of public agitations. The government comes for the rescue. You fix the price not 100 rupees, you fix the price at 70 only. Then immediately all the companies are agitating, sir, 100 rupees is really good enough for us to make good profit. If you are asking me to fix 70, we will be losing the profit, sir. The government says, if you fix 100 rupees, then there will be lots of public agitations. People will be retaliating adversely about the government. So you have to fix at 70. No botheration about the discount offered by you 30 rupees. We'll give the compensation. So this compensation is called as subsidy for the revenue loss. In case of electricity, what happens? Okay, electricity companies are making huge losses. Tamil Nadu Electricity Board making huge loss. They want to double the unit sale price. Electricity price should be doubled. Only then it will be affordable for them. Already the electricity bill gives lots of shock without touching the electrical wire directly, right? The bill itself shocking. So if the price is double, what happens then naturally? Electricity company will be, of course, they can make the profit, but public agitation will be very high and they will be against the ruling government. So the government says, you fix that same 10 rupees. Whatever the loss is there, will give the compensation. The compensation given by the government for revenue loss is nothing for the owner's fund only, You can use the subsidy for the revenue loss for the distribution of dividend. So out of state subsidies, money provided by the central government or state government for the payment of dividends in pursuance of a guarantee given by that government. Government has given the guarantee, you sell for 8 rupees. Rather than selling for 10, if you are selling for 8 rupees, there's a last 2 rupees. Will you give the guarantee? If the subsidy is for the guarantee, it can be used for the dividend distribution. Is that clear? Now, if you make any profit on sale of assets, can I use this, sir, for the dividend distribution? Rare scenario. If you don't have any profit to be distributed as a dividend to the shareholders out of the above said source, you can use this one also, provided some conditions should be fulfilled in this case. So dividend can be predominantly offered only from the current year's profit, or any profit remains undistributed in the previous year can be used for the dividend distribution in the current year, not other than that. Third point, you can use some from the current year, some from the previous year's accumulated profit. Last one being state subsidy. Revaluation profit cannot be used for the dividend distribution. Revaluation profit you don't get in cash form. So if you are selling any asset, you are realizing the cash can be used for the dividend distribution, provided some conditions should be satisfied. Now, remember, dividend declaration out of accumulated profits of the previous year. Okay. Now, you can use the current year's profit for the dividend distribution, no problem. Current year's profit is not sufficient, sir. Can I use the previous year profit, accumulated profit for the dividend distribution in the current year? Yes, but there are some restrictions. The restrictions being this one. Okay. Now, the current year profit is less than your dividend supposed to be distributed. Then accumulated profit can be used for dividend distribution. Accumulated profit. Okay. In this case, the rate of dividend being less than or equal to 3 preceding years average rate of dividend. Okay, you cannot go beyond that. So previous year 24, 25, 23, 24, 22, 23, 21, 22. Here the profit being 8% dividend, 10, here 12. Now, how much you can offer? The average of 3 preceding previous years value 10%. You cannot distribute the dividend in the current year more than 10%. More than 10%. If you are going to take from the previous year. Only average, less than average. 10% or 9% or 8% you are allowed to use. Not 12% or 14%. You are not eligible for giving more than the profit earned in the previous year. Okay, so previous year 12, sir, this year I want to give 13%. No, only the average of the 3 years. As this year your profitability is not adequate enough to pay the dividend, only average of the 3 or less than that you can offer. So to that extent you can withdraw from the previous year statement number 1. Not only that, amount drawn should be less than 1/10 of the paid up share capital of the free resource. So equity share capital 100 lakhs, reserves and surplus being 300 lakhs. In that reserves and surplus, 100 being the free resource, 200 being the specific resource. You cannot use it. So free resource being this one. Equity share capital and this one, if you add these two, 200, no, in that 1/10, 20 lakhs only can be withdrawn from the previous year. Means from the 100 you can withdraw only 20 lakhs. Whatever the accumulated profits we have in the previous year being the free resource, and only 1/10. And such amount withdrawn from the previous year will be used for adjusting the current year's loss, if any. If the current year's profit being 5 lakhs, withdrawal limit is 20 lakhs, 20 plus 5 lakhs, 25 lakhs can be used for dividend distribution. But current year we have a loss of 5 lakhs. You are allowed to withdraw only 20 lakhs now. In that 20 lakhs, first you use the 5 lakhs to be set up, balance 50 lakhs only dividend is distributed. Even if you are having the limit for withdrawal, that withdrawal amount is also restricted to the extent of accumulated losses in this current year. Okay. Now, amount drawn should be utilized first to set off losses. These are the 3 points. The fourth one being reserve after withdrawal should be more than 15% of the paid up share capital in free resource. Okay. So paid up capital being 100 and your free resource being 100, 200. So how much you are allowed to withdraw as per point number B? Point number B, 1/10 can be withdrawal, 20 rupees. And after withdrawing this reserve 100 minus 20, you have how much? 80 rupees. This 80 rupees should be how much? Should be more than 15% of this value. More than 15%. Okay. You have to verify after withdrawal, the limit amount available should be more than 15% of the paid up and free resource. And dividend can be declared only after set off of the previous year's loss. So these are the 2 things. This will be the current year loss. This is the previous year's loss. All the loss will be set off. Thereafter, whatever the amount left over can be used for the dividend distribution. If the current year profit is sufficient enough, no problem, you can distribute as you wish. But if the current year's dividend is not profit is not sufficient enough to distribute your estimated profit, then there is a restriction to withdraw from the previous year. So you have to satisfy all the 5 conditions before you distribute the profit dividend from the current previous year's accumulated profit, right? Now, in case of partly paid up shares, what happens? Equity share capital face value being 10, but out of that, only 7 rupees is paid up. This is paid up capital. This is paid up capital. Only 7 out of 10 is paid up. Proportional payment. Then if the company plans to distribute 10% dividend, how can we pay? Is it on 10% 1 rupee or on 7 rupees 10% 0.7? How can we pay? Usually proportionately only we payable. Only 0.7 is payable as per schedule number 51. Proportional payment of dividend. You have fully paid up shares as well as partly paid up shares both. For fully paid up shares, you can pay fully. For partly paid up shares, to that proportion extent you can pay. If only 70% is paid and whatever the dividend you are supposed to pay for a share, only 70% will be payable for the partly paid up shares. Is that okay? This is as per schedule number 51. If the shareholders pays the money in advance, calls in advance, will he be eligible for the higher dividend? No, sir. In case of calls in arrear, not eligible. In case of calls in advance, what happens, you know? It's paid 10 out of 10. The 3 rupees is considered as advance money paid. Now, the while dividend payment, you have to pay the dividend only for the 7 rupees. For the 3 rupees, dividend will not be payable. For the 3 rupees, of course, interest is payable. Interest is payable. In case of calls in arrears, sir, one fellow has paid only 5 rupees, sir. What the dividend will be payable? Dividend will be payable for 7 rupees, no problem. For the 2 rupees calls in arrear, no, for the dividend is recovered. Okay, the person who paid lesser is also be eligible for 7 rupees dividend, and the person who paid more than 7 rupees also eligible for 7 rupees. The person who paid more than 7 rupees should be compensated by way of paying the interest. The person who paid lesser will now recover the interest from him. Also be possible. Is that clear? Calls in advance as well as partly paid up share scenarios. Now, while transferring the amount to reserves account, usually board of directors can transfer a part of profits to the reserves account. But in case of banking company, there's a commitment. At least 25% of the current year's profit should be transferable to the statutory reserve available for the companies. Depending upon the situations, in case of fire insurance and marine insurance, whatever the current year's premium they receive, in that a portion is transferred. That law will be applicable. Otherwise, board of directors will decide to some extent of the current year's profit can be transferred to the reserves account. Okay. Now, payment of dividend out of capital profit. Usually revenue profit is allowed to give the dividend. Can we use the capital profit, sir? Means any profit generated by selling the assets. Okay. Also state payment of dividend out of revaluation. So usually capital profits cannot be done, especially revaluation of fixed assets. In your balance sheet, fixed assets rupees 1000, you restate this as 1500 today because of the revaluation. That 500 rupees is now considered for the dividend payment. Is it possible? No. Then automatically everybody will cheat. All the assets available in the balance sheet are inflated to the higher value, stating that huge profit we earned and I am going to distribute the dividend to shareholders. Like if the shareholder, the promoter being the shareholder holding more than 80% share, he will take all the cash with him. Then others will be getting trouble. So you have to be double cautious when you are being the in position to distribute dividend out of the capital profit. Always remember the capital profit should be in the form of cash. Revaluation profit is not in the form of cash. Only you are inflating the assets value. There is no any cash realized, so you are not allowed to give this. Okay, revaluation of fixed assets, and in that case, the capital profit can be given. No, dividend cannot be declared out of the profit on revaluation of fixed assets since it's a notional profit only, which is not realized in cash and is obtained from the revaluation of capital assets only. It's not in the form of cash, so it cannot be used for the dividend distribution. Now, in case forfeited shares reissued, While forfeited shares reissued, there may be gain available while forfeiture. After reissue, that forfeiture gain is transferred to the capital reserve account. That capital reserve account, can be used for the dividend distribution because they have to be realized in cash. They remain as profits even after revaluation of all the assets and liabilities. AO does not prohibit company for the purpose. So these are the things are there. Yes, reissue of forfeited shares, because of that amount is released in cash and this profit is available even after the revaluation, and AO is also doesn't prohibit. Yes, dividend can be declared out of the profits or reissue of forfeited shares. Only conditions are satisfied. So all the conditions satisfied. So in this case, yes. In this case, no. In this case, yes. And another case, no. Clear? Now we'll go for the managerial remuneration calculations. Managerial remuneration. Schedule number 5 and part 2. Now, let's see. You are okay with the following information for AD Vita Limited. You are provided with the following information for AD Vita Limited for the year. Net profit before provision for income tax and manager remunerations, but before depreciation being this one. Okay, this is the net profit before manager remuneration and depreciation. But after depreciation. But the depreciation will be provided in the books. But you have to calculate the depreciation as per the schedule number 2 of Companies Act. So for the PGBP calculation for the income tax purpose, you depreciate as per section 32, Similarly, whatever the depreciation you debited in your P&L account is not acceptable for the calculation of manager remuneration. So for that, you have to go and refer the schedule number 2 of Companies Act. If you follow the rates of depreciation allowed under Companies Act, the depreciation being only 3,09,000. So here net profit for the for the company being 13,87,600. This one is arrived after debiting the depreciation at the depreciation of rupees 4,15,000 as per the financial account. But I should not debit this one. What I have to debit? I have to debit as per the Companies Act, which is 3,09,000. So this is disqualified, add back, and this will be allowed to be deductible. It's going to be subtracted. So depreciation as per the books is going to be disqualified. Minus depreciation as per the Companies Act is going to be subtracted. That you studied in your PGBP calculation in income tax. Depreciation as per the books is added back. Depreciation for the income tax purpose under section 32 is deducted. Similarly, depreciation rate for the Companies Act is totally different. So as per the Companies Act, if there is any depreciation, that should be subtracted. Now, 13,87,600 with that 4,15,000 is added, 3,09,000 is subtracted. What is the final value? 14,93,600. Okay. Now you are required to calculate the managerial remuneration when there is only one whole-time director. If we have only one whole-time director, you have to calculate depreciation managerial remuneration, the maximum being 5% of this value. 5% on this value. Okay. Net profit for the managerial remuneration. If we have two whole-time directors, for every whole-time directors 5%. But the maximum ceiling for any number of managing directors is only 10%. Is that clear? If you have only one whole-time directors, 5%. If you have 5 whole-time directors, for every whole-time directors 5%, but in total it should not be beyond 10%. When there are 2 whole-time directors and 1 manager, okay, then the value being 11%. Yes, come on, calculate 5% on this. And here 10% being, okay, 11% being clear. Okay, this limit you have to understand. When net profit is positive, in case of net profit 5%, 10% and 11%. If the company makes a loss, won't they get any income? No, they will be given. So we'll see that later on. So let me finish up the entire list here. If we have only one whole-time director, whole-time director, then 5%, and more than one whole-time director, then 10%. Other director not being whole-time director, we don't have the whole-time director, we have only part-time director. In that case, only one part-time director means 1%. If you have n number of part-time directors, okay. So here, one whole-time director, so part-time director, and we have whole-time director also. So whole-time director only, one whole-time director, then 5%. Whole-time director, okay, 2 and more, then 10%. You have whole-time director plus part-time director, where part-time director's remuneration is 1%. We don't have whole-time director, we have only part-time director. Then the remuneration to the part-time directors being 3%. Is that okay? Overall maximum being 11%. Overall means you may have full-time director, 4 or 5 full-time directors, you may have 3 or 4 part-time directors also. So for full-time director, 1 means 5, 2, 3, whatever it may be, restricted to 10. With the whole-time directors, if you have multiple part-time directors, for all the part-time directors put together, only 1%. So at maximum 11% will be. Is that clear? Now, remuneration payable by companies having no profits. If the company has profit or loss. In case of profit, 5%, 10%, 11%, and 1% and 3%. These are the number you have to understand. If the company is not having any profit or loss making company, or profit is insufficient, then what happens? We now consider the capital employed, effective capital. So based on the investment made by the company, the remuneration is going to be fixed. If the effective capital of the company is less than 5 crores, even negative, we don't have the capital at all, everything is wiped off, loss only accumulated, huge. Equity share capital 10 lakhs, accumulated losses 20 lakhs. Then automatically what happens? The shareholders' funds is minus 10 lakhs. So in that case, the equity capital means the effective capital is 5 crores and less, then remuneration to all the directors put together should be 60 lakhs, maximum remuneration. And if it is anywhere between 5 to 100 crores, then 84 lakhs. 84 lakhs, another 24 lakhs excess. If it is anywhere between 100 crores to 250 crores, then this should be 120 lakhs. If it is more than 250 crores, okay, then 120 lakhs plus 0.01% of effective capital employed in excess of 250 crores. For example, 1000 crores. What could be the remuneration? In case of 1000 crores, 120 lakhs is constant, and from 1000 you subtract 250 crores. For that balance amount, 0.01% will be calculated. Come on, tell me. 750 into 0.01%. 0.0 0.075 0.75 is 0.75. Okay, this will be the amount paid. This will be the amount paid. So, effective capital negative or less 60 lakhs will be the maximum remuneration. Anywhere between 5 crores to 100 crores 84 lakhs, 100 crores to 250 crores to 120 lakhs, 250 crores and above 120 lakhs plus 0.01 for any excess effective capital over 250 lakhs, 250 crores. I think this is 120 lakhs. This will be 750 crores, otherwise 750 100 lakhs into 0.01. Come on, get me the value. $120 lakhs. Yes, come on. 7.5 lakhs. 127.5 lakhs is the answer. Okay, make the corrections. It's in crores. It is in crores, 120 lakhs. Now, so what is called effective capital, sir? What is called effective capital? Effective capital means aggregate paid up share capital, excluding share application money pending allotment, advances against the shares, but you have to add what? Securities premium, resource and surplus minus loss. Okay. So this one and this one. Number one being aggregate share capital. Any application money you receive will not be forming part of share capital. Advances against share is similar to warrant. Share warrant and application money pending allotment. These two are excluded. Only pure share capital will be taken. Resource and surplus. Securities premium, resource and surplus, all the accumulated profits will be taken. If there is an accumulated losses, that should be subtracted. But revaluation reserve should not be considered. Because revaluation reserve is not in the form of cash, should always be eliminated in your overall calculations. And long-term loans and debt can be addable, where it should not have working capital loans, OD, short-term loans. You have to take OD the long-term loans. In that case, investments, okay, except in case of investment in companies, you have to remove all the investments. Because investment is not part of the investment made for the company. Okay. In your balance sheet, okay, you have property, plant, equipment, and non-current investment. Here, share capital, resource and surplus, non-current liabilities. Now, what is your duty? As you are being the administrator, shareholders are giving the money. Using that money, you have to run the business. Okay. Run the business and generate the income. Whatever the money I give to you, you just deposit in the bank account and you are getting the interest and sharing the interest to me. Means what's that? You don't do any role. I can also invest in the bank and I can easily get the interest. Why do I want to invest in your company? You have given me some objectives, sir. With your money, I am going to do a business, and from the business, the income is generated. I am going to give that income to you. So, if I am giving the money as a shareholder, this money should be invested only in the business. But if you are investing somewhere other than your business, this is none of your business. Remove that. I will not bother about that. Then what about your investment? The investment is absolutely what? Investment made for the business, where you are going to subtract this one. Okay, 1000 rupees, 500 rupees, 500 rupees, and this one being 300 rupees. So, from the 2000 rupees, 300 rupees is not related to your business investment. Only 1700 is validly invested for the business purpose. I will consider this only is for your effort. I pay the interest, I pay the remuneration only when your investment is made in your business and income generated. If you are investing 300 rupees here and you say, I earned so much of interest, then yeah, as a shareholder, you will say, don't invest, sir, I will invest. So your effective investment is being the investment made other than the non-current investment, means non-operating investment. It is not related to your business operation, remove it. But if you say, sir, this non-current investment I made, also related to our own business, then that will be forming part of the capital employed. So, except in case the investment of similar companies, that's okay. That's okay. Okay. If even a layman can invest, then why do you invest? As you are being the expert, you should not invest there. You have to invest in your own business and generate the income. So, share capital, resource and surplus, and non-current liabilities. Add up all these things. From there, non-current investment, if any, should be subtracted, provided that non-current investment being related to the operation means no need to subtract. No need to subtract. This will be the effective capital. If this value is 0 or less than 0, then it is called negative. Only then the basic remuneration 60 lakhs, 84 lakhs, and 120 lakhs are going to be payable. You can hear date of effective capital is on the last date of the financial year preceding the previous year in which the appointment is made. Whenever he was appointed and prior to that, the last date will be taken. So, for example, if he is appointed on 1st January 2025 and previous year last date being 31st March 2024, in that date effective capital will be taken. That will be the base for the remuneration calculations. Is that clear? And here family means spouse, children and parents being the dependent for the managerial person. Okay. Now, one more point to be noted here. The managerial remuneration payable to the directors, directors, perquisites will not be included. The remuneration what we have calculated is apart from the perquisites. Okay. And other details, PF, superannuation fund or annuity, if not taxable, also be excluded. Gratuity should be less than or equal to half month salary for each completed years of service, also be excluded from the remuneration. Any leave encashment received also be considered as not being the managerial remuneration. And for expatriate managerial personnel, okay, foreign, okay, the directors are from foreign country working in India, and in that case, including non-resident Indian, okay, maybe it's being the non-resident. Children education allowance will also be excluded. 2 children, whichever is lower of actual or 12,000 per month. It is not as per Income Tax Act, it is Companies Act. Okay, 12,000 per month per child or actual. Between these two, whichever is lower is excluded from the managerial remuneration. And he is from foreign country, no. So holiday passage for children may be also allowed. Economic class or first class once in 2 years. Once in 2 years. Okay, leave travel concession. These things are excluded from the managerial remuneration. Right. Now, we have studied that maximum limit of managerial remunerations, a percent on the basis of net profit is payable. That's how we learned here. Remuneration payable by companies having profit under section 197. If the company has no profit, based on effective capital will be paid. Now, what about the net profit, sir? Net profit is not the profit as per the books you prepared. From there, you have to do some plus or minus to arrive the net profit for the managerial remuneration. On that only that 5%, 10% will be applied. So last illustration is the same, no? In this illustration, 13,87,600 is nothing but net profit as per the books, but we will not take that for the remuneration calculations. From there, we do some plus or minus for adjusting the income for as per the Companies Act provisions. as per Companies Act provisions. Clear? Now, what to be included, what should not be included? Net profit as per section 198 of the for the purpose of managerial remuneration. 197 states that this is the percentage of remuneration is payable on the net profit. What is the net profit? Net profit as per section 198 is there. So as per section 198, how do we calculate the net profit for the managerial remuneration purpose? We start the profit as per the books. Okay, like PGBP calculation, you have to calculate this one. But for the managerial remuneration purpose, this will be very rare question. But anyhow, you have to know some bit of knowledge. Now, subsidies and bounties received by the government or public authority can be includable. Subsidies, already we studied now. Subsidy for the revenue loss because of the government's control, right? So they will give the subsidy, that is also forming part of the profit only. Now, what about the premium? Can we consider the premium being the net profit for the dividend distribution or managerial remuneration distribution? No. So, not credited. Profit on sale of forfeited share is also not related to the business operation. Any profit not related to the business operation should be removed. Any profit being the capital nature should be removed. Profit from sale of property, plant, equipment will also be removed, and profit on revaluation of assets and liabilities should be removed. So all these things are not related to the regular business operations, should be removed. And income tax should also be removed. And voluntary payment of compensation, voluntary. And director says, sir, it is not required, sir. You are deducting this and giving me remuneration lesser. After deducting this profit means I am getting lesser. I don't never accept this one. So the profit being 1,000, suddenly promoter deducts 200 rupees as voluntary compensation and says only 800 rupees. Remuneration payable to the directors being only 5% than this 40 rupees. Okay. He says, so I won't accept this, sir. I don't accept this, sir. Why do you give this 200 rupees? It's voluntary. Voluntary should be in your pocket. It's not affecting my remuneration. So, 1,000, in that 5% is 50, you have to pay me 950. This is the 950 is the amount for the promoter. From that, you can give the compensation. In case of voluntary compensation, that cannot be debited in your P&L account before you for the distribution of managerial remuneration. So, you have to remove this. And profit on capital nature is removed. No, similarly, loss on capital nature should also be removed. And depreciation as per the Companies Act is deducted. Any depreciation as per the financial books, removed. You have to calculate the depreciation as per the Companies Act. Only that is going to be deductible. Is that clear? I have given as a statement like very easily you can understand. So, subsidies for the revenue loss given by the government is added. And any not related to the that business will be removed. And in case of depreciation of the Companies Act, deducted. Depreciation already given will be removed. Now, all usual working charges like administration expenses and selling expenses and advertisement expenses, those things are the normal working expenses can be debited. Directors' remuneration can be deducted. Bonus or commission payable to the employees deductible. Tax notified on excess or abnormal profits. This is very, very important. Tax notified on excess or abnormal profits deducted. Tax on business profits imposed for special reasons can be deductible. Now, regular income tax not deductible. So we have been given 3 taxes here. One is income tax. So managerial remuneration is the expenses only, expenses is deducted. Thereafter, whatever the profit is there, that will be for distribution for the government as well as owner. If the income is 1,000 rupees before managerial remuneration is also expenses, say 100 rupees deducted, 900. From there, you can subtract for the taxation. Taxation being 30% means 270, balance is for the owner's fund. This is the expenses, not appropriations. Expenses means after deducting whatever the leftover can be used for the tax payment. Okay. After this expenses, whatever the balance that balance is for the tax payment. Clear? Now, this income tax can be subtracted. But two different taxes are there. Those two taxes will not be deductible, will be deductible first of all. Okay, this tax cannot be deductible. 1000, you have been given three tax: income tax 100, and abnormal profit tax 50, and tax for special reason 150. This 1000 rupees is before these three taxes, but you can subtract these two taxes from here, 800. From there, you can calculate the manager remuneration. This tax is the regular tax, not deductible. Not deductible. Now, what about these two taxes, sir? I just brief here. Excess or abnormal profit. You should have the profit reasonably some number, 20% or 25% or 15%. Like government says, these are very, very important commodity for the day-to-day consumption of general public. If you are exorbitantly pricing this, then what happens? The general public will be suffering. So the government, some cases, says the profit earned from this business should not be beyond 20%. You calculated the year's profit and found that your profit is 25%. Government immediately comes, I told you to make only 20% profit, you made 25% profit, excess profit. So it is illegal. So additional profit you earned another 5%, on that you have to pay another tax. That is called tax on abnormal profit. Where this will be available, sir? Only in electricity board. In case of electricity company, they should not make the profit beyond their limit. Earlier they have to pay additional tax for the abnormal profit they earned. And earlier it should be refundable to the consumer. Okay, so electricity company, for 100 rupees of investment, they need to earn a profit of 15 rupees only. Suddenly a company made 25 rupees profit. What happens? Immediately government warns you, you're exorbitantly billed and consumers are suffering. So only 15 rupees is your profit, balance 10 rupees you have to refund. How to refund, sir? It is not going to be refundable. Subsequent period, because of the price hike, the tariff should be inflated. No, by the time you don't inflate, you adjust this 10 rupees for any losses later on you are doing without raising the price. Such a case, you're restricting your profitability also. If you are making abnormal profit, there will be additional tax, that is a penalty only. So you have to deduct that one. So you have to deduct these two. You should not earn this profit. You should not earn this profit. If you are earning, this is an unwanted one. So you have to subtract that. Your profit is decreasing from 1000 to 800. On that 800 only, manager remuneration will be payable. But this 100 will not be subtracted. Clear? So now, tax notified on excess or abnormal profits, tax on business profit imposed for special reason. These two will be subtracted before calculating the manager remuneration. But regular income tax will not be. Okay. And what more? Interest on debentures can be subtracted. Repairs not being capital nature, deductible, and depreciation under section 123 deductible. Any loss also be deductible, bad debt also be deductible. So not beyond that. So major items, you can guess yourself. Few items like tax on abnormal profit, tax on profit earned because of special reason. Those things will be now subtracted. But regular income tax will not be subtracted. Usually I have seen most of the questions related to the only depreciation. Depreciation as per the income tax means Companies Act purpose is this much. Depreciation charge is this much. So you can understand that you have to deduct the depreciation as per the Companies Act for this purpose. Where if you are studying the PGBP, you have to subtract the depreciation as per the income tax purpose. Is that clear? Hope now you'll be able to understand the small theoretical background of these chapters. And before wind up this lecture, let me see here. And framework and all is as per the accounting standard board is given, and other theories also given here. Components of financial statements also there, and who are the users of financial statement also. All these things are the theory you might have studied at the preliminary course itself. Fundamental accounting assumptions are these things: going concern, consistency, and accrual. These are the three fundamental accounting assumptions we have. Now, usually you prepare financial report as going concern. Okay, going concern. Now, the property, plant, equipment being 65,000 rupees. Okay, today if I want to sell this property, plant, and equipment, you'll get only 30,000 rupees. This is what about scrap value or realizable value. If you want to purchase a new plant and machinery, it costs us 75,000 rupees. This is called replacement value. This is book value. Book value is nothing but cost minus depreciation. This is called book value. Is that clear? So we have been given three values. Now tell me, what value you will usually take for preparing final accounts? Is it scrap value or realizable value or book value? Usually take the book value only. If I want to sell, then I will sell for 30,000 only. Now the question is, are you going to sell the asset? No, sir. I'm going to run this business for a long time. The mobile what you have now, okay, maybe purchased at rupees 10,000. If you want to sell the mobile, at what rate you will be able to sell? Only 2,000. Even that is also doubtful. If I ask you, it is not worth the 2,000 rupees, sir, I will give 2,500. Give me, sir. No, sir. Why? I'm going to use it for a long period. If I give this mobile to you for my studies, I have to purchase new mobile. If I want to purchase new mobile, it costs me 15,000 rupees. So if you are having this to be used for a longer period, then it's called going concern assumption. In that case, the book value will be taken, not scrap value, not realizable value. That's the logic. So preparing the final accounts under going concern model is nothing but based on the book value you have to proceed. You can have the glance over this topic easily, you can understand. And accrual basis. So what model we follow? Accrual and cash basis, we have two methods. What model we predominantly following in our accounts? Accrual basis. So to differentiate what is the difference between accrual and cash basis, this illustration is there. Of course, it is also not required. Okay. So what happens here? Actual cash, actual credit term is given. Okay. A trader purchased an article on credit 50,000 rupees. And he also purchased an article 2,000 in cash. In case of cash basis, you write only 2,000 rupees. In case of accrual, you have to write both the value. Okay. So in cash basis, purchases 2,000. In credit basis, 52,000 rupees. What model you will follow? Only credit model is followed. Accrual basis. That's all. Okay then. This is again accounting equation like. Okay. I request you to have the glance over this to understand historical cost, current purchasing power, current cost basis. Okay, you can try to understand this one yourself. So with that, this chapter is completely over. Some theoretical questions also there and theory component also there. I think you might have covered all these things in your company's law. There you might have learned everything in detail. Here I have given a briefing about types of companies and all, so not required. Clear? That's all for this chapter.